So this is Chapter 20, Part 1 lecture. Chapter 20 is really kind of shifting gears. The first three chapters we talked about really cost accounting, cost flow through the different inventory accounts into cost of goods sold, how we apply factory overhead to jobs, how job costing and process costing works. Then we looked at further explored how we could allocate factory overhead on a more precise basis. And then we looked at support department allocation and joint cost allocation. So the previous 5 chapters really just looking at how costing works, how we end up getting costs into products, and ultimately being able to establish inventory balances and cost of goods sold. So now we are shifting gears. We're getting into a little bit more analytic analysis of costs and how costs behave. And different costs behave differently, and we're talking really over changes in volume. So we're talking about the way variable and fixed costs may change relative to changes in volume. And the reason that that's important is because now, once we understand the way our costs behave, now we can look at volume changes or changes in those particular costs and understand what the effect on our profit is. So obviously, in any business, we're going to want to understand what will change, or what type of dynamics affect our profitability. And in this chapter, we're going to learn that there's some real simple, basic, but very powerful tools in which we can use to evaluate how changes in volume, how changes in our cost structure will affect our profit. And from there, we can use that to better make decisions in terms of future events or proposals that we might undertake. Now, the beauty of all this is that we can do what's called incremental analysis. So we don't have to reconstruct, very lengthy, timely income statement analyses every time we want to change one little tiny variable. What we can do instead is we can evaluate very quickly, how does the change affect our profit? So it's really just looking at the incremental effect of one change in volume or cost, and what's that incremental effect on our profit. So if volume goes up by a unit, what's the effect on our profit? And or if cost goes up by $1, what's the effect on our profit? So that's a very powerful tool to be able to use, but it again requires understanding really how our costs behave. So before we even get into cost behavior and understanding different costs, so let's just take a real simple example. And it's what I call a cookie example. But we're going to be producing cookies. Maybe we have a cookie shop. And basically what we're going to do is we're going to, in terms of the cost of our cookie, we've got direct material costs. Maybe it's the dough, 50 cents a cookie. We've got someone obviously cooking the cookie, preparing it, and that's another 50 cents worth of costs. And then again, just for simplicity, we're going to say that total cost per cookie is $1. There may be some other costs, but we're going to ignore them for the time being. We're going to sell that cookie for $3, and we're going to pay rent $1,000 for the month. So that's kind of the base assumption that we're going to work with, and we're going to just look at 1 month's period of time here. So let's just go through maybe a couple of questions real quick, and we'll see how easy and sort of intuitive I think this can really be before we get all bogged down into different formulas. But so first of all, without knowing the actual volume that we're currently doing in our business, how much incremental profit do we make each time we sell one more cookie? So if we sell one more cookie, how much additional profit are we going to make? And again, you can pause the video at this point and go ahead and answer the question. So the amount of incremental profit that we're going to make on each cookie is we're going to sell each cookie for $3. So the selling price is $3. And the variable cost, or the direct cost in this case, would be $1. So each time we sell a cookie, we're going to make $2. And this would be variable costs. The $2 is what we're going to call contribution margin. And that's basically, and we'll come back to this later, but that's basically the amount of profit that you're going to make on each incremental unit that you sell. So it's going to be basically your selling price minus the variable cost, and that's going to give you the contribution margin, and we're going to just use CM for that. Okay, so contribution margin is the incremental income from selling one additional unit. So every time we sell a cookie, one more cookie, we're going to make $2. Now you might think, well, what about the rent? Is the rent going to change if we sell one more cookie? No, the rent is going to stay at $1,000 a month, so that additional cookie is going to give us an additional $2 of profit. And so we're not going to need to sell any additional, so our rent is not going to change based upon volume. The rent is going to be fixed. It's going to be a fixed cost. And we'll just note that here. It's going to be $1,000 a month, so it doesn't matter how many cookies we sell, whether we sell one cookie, theoretically one cookie, or a million cookies. Our landlord is interested in getting $1,000. So that one additional cookie isn't going to change how much we're paying in rent, and therefore we're going to make an additional $2 every time we sell one more cookie. All right, so then the second question is, so how many cookies do we need to sell to break even? And again, you can pause right now and see if you can answer that question. So here in this case, how many cookies do we need to sell to break even? Well, first of all, we're going to make $2 per cookie, right? So if we make, so we'll just say n is the number of cookies. So we're going to make n times $2. And then all we really have to do is be able to make enough, make enough to cover the rent, and then basically have zero profit left, which would give us break even. So we're just going to be able to subtract 1,000 of rent. So this would be our profit here. This would be our rent here. And we just want to end up with zero. That would be break even. So break even would be zero profitability. So if we solve for n, I think it's pretty easy to see what the answer would be. We would need 500 cookies to break even. So if we had 500 cookies, we make $2 per cookie. That's $1,000. That's exactly equal to our rent. And that therefore we've broken even. Now we're going to just move these numbers around a little bit, and we're going to put our rent, which is our fixed cost, and we're just going to calculate our break even. So we can just rephrase this as this formula: break even, the number of units, that would be n, and it would really just be our fixed cost, or our rent, divided by the $2, which is our contribution margin. So again, in this case, we've got the $1,000 divided by the $2, and that would give us 500 cookies. So that's basically the equation that we're going to use in this chapter to calculate break even. But again, intuitively, we were able to kind of figure that out just thinking about it in terms of this equation. What did we need to sell if we made $2 per cookie just to cover that rent? But that's how we're really going to be thinking about break even. Okay, but we're going to be using this equation to the right. So another question that we could answer is, if we actually did produce 2,000 cookies, what is our actual profit? Just based on the information we have, every time we sell a cookie, again, we would make $2, and we already know what our rent is. So we could easily, again, incrementally look to see how to solve this. So you can hit pause and go ahead and do that calculation. In this case, we do 2,000 cookies times our contribution margin. Every time we sell a cookie, we make $2. That's $4,000 minus our rent of 1,000, because that doesn't change no matter how many cookies we make. And so we would be making a profit of $3,000. So here again, using contribution margin to quantify the total amount of profit that we make on each cookie, and then subtracting from that any fixed costs that we might have that do not change as a result of volume. So our profit would be $3,000. Again, before I mentioned that we can look at things incrementally to evaluate what change in volume might do to our profit. So here, what would be the extra profit if we generated $600 of additional sales? So here, we're making $3 for each cookie. So that would mean that we would be selling 200 additional cookies. $600 divided by $3, that would be 200 cookies. And again, every time we sell a cookie, we make $2. That would be an extra $400 of profit that we would make. And again, the rent doesn't change regardless of the volume. So that would be, again, incremental profit is contribution margin. Contribution margin is the amount of money we make on each additional cookie we sell. So let's take a look at 5. Here we have number 4. We looked at what happens if our volume increases. How about 5 in case in the situation where our costs change? What's the effect in terms of our volume? What would we need to do to stay in the same situation to absorb that increase in rent? So here, if rent increased $200, how many more cookies would we have to sell? Well, I think one way to think about that was if we had a $200 increase, we would need to sell 100 extra cookies because we make $2 per cookie. The extra 100 would offset the 200. The other way we could look at that is use our break-even formula. And again, that would be our fixed costs, in this case our rent, $200, divided by our contribution margin of 2. That would give us 100 additional units to stay at the same level as we were before. And again, break-even doesn't mean that we're at break-even in our business, but it's a way of incrementally looking at staying in the same position as we were before. Okay, so in this case, to stay at the same position, to absorb that $200 rent increase, we can use break-even to determine that we need 100 extra units. And finally, if we could reduce the rent by $200, but our volume drops by 125 cookies, should we do that? In other words, let's say we could find a cheaper location, but our volume would drop because there's less traffic. Should we do that? Well, first of all, we would save $200, but we would also lose 125 cookies rather, and each time we sell a cookie, we make $2, so we would lose $250. So net, we would lose $50. We would be worse off by doing this. We should not move.